Okay, good afternoon, Chantal and Jason. So clearly a lot is going on in the market these days, right? This COVID-19 crisis has been quite an event, once in a lifetime event, I would say, putting severe stress in the market, also in our private lives, actually. Um, Especially when liquidity conditions are concerned, right? The high yield market reacted very badly to the crisis, for example. So there have been quite an incredible stories. So what does this mean for the financial industry, and what challenges does this involve?
Yeah, I'll start. Thanks, Dario. Well, there's certainly lots of challenges, some immediate and some more longer term. I'll discuss first some of the longer term regulation related effects. Looking back a little bit at history to potentially inform us of what might come. So we saw a significant response from the regulators after the 08-09 global financial crisis. The focus was first on systemic risk monitoring to ensure that individual financial market participants and their transactions and holdings didn't represent too large of a risk in the entire system. So there were some new regulations that were particularly heavy in the alternative space, which was a substantial holder of those mortgage-related securities at the heart of the 08 crisis. So new regulatory reporting requirements were issued both in Europe and the United States, including ESMA's AIFMD Annex 4 quarterly reporting, and the similar Form PF for private funds in the US and CPO-PQR for commodity pools. But that regulatory reporting trend wasn't limited to alternatives. There were, of course, capital-related and solvency-related regulations in Europe as well. In the United States, the SEC created new reporting requirements for money market funds, which, of course, had also broken the buck during the last crisis.
Yeah.
So the monthly Form NMFP required holdings level disclosure and liquidity statistics in that one. ESMA has only recently required money market funds to start reporting similarly with the new money market fund regulation, which has added some more focus on that liquidity aspect. And then finally, there are new holdings and liquidity reporting in Form Import in the United States and Form Liquid as well, that applied to 40 Act funds. So all these new regulations represented a significant new burden for asset managers and their administrators who served them after the last crisis. So what happens now? Well, we can only speculate about what the regulators' response to the current COVID-19 crisis might be, especially because it's certainly still in progress from a public health perspective, and the financial market impact is still ongoing and not fully known. We have seen some regulators in Luxembourg and France recently start scrutinizing more reports more closely, so perhaps that's a first step. However, we clearly saw some massive volatility and significant liquidity stress activity in March, and I'm sure Chantal will get into some of the more detailed results that we've done on the liquidity stress testing. But roughly speaking, maybe these ESMA liquidity stress testing requirements are aptly timed because of all what's going on, and I'll probably be heavily scrutinized. So my guess is, all told, that there'll probably be a lot more regulatory requirements that will result. I just don't know what they'll be.
Yes, it's very good. Chantal, what about
That's
you?
very right, Jason and Dario. It's very important also to stress how the behavior of the markets around the COVID-19 has actually been extraordinary so far. Jason mentioned it. For example, just looking at the month of March, standalone, the volatility of the corporate bonds more than double, as well as the credit levels as well. So given the inevitable global economic slowdown caused by the virus, actually large amounts we have seen in US investment grade corporate bonds, for example, have started been facing higher risk of downgrade. What does this mean? It means that there's a clear symptom of deterioration in the credit quality in the market, in some cases also explained by the increasing lack of liquidity in the market. And typically bid-ask spreads usually capture these kind of movements. So even when we consider also the historical events over the last 2 decades, we can actually see how the COVID-19 actually goes beyond any previous occurrence, almost doubling also the cost registered in correspondence of Lehman Brothers crash or Black October in 2008. So across a number of asset classes, not only bonds, but also equities, balanced portfolios, and so on and so forth.
Absolutely, and the timing of actually the regulations already was, I think, as my liquidity risk was September of this year, right? The new liquidity risk stress testing. So it was decided before COVID. That's a funny coincidence. can you give us some insight into the methodologies, terms around liquidity, what liquidity risk means? How it's possible to capture liquidity risk? How do you do that?
Yeah, sure, Dario. So in recent times, actually asset managers, risk manager, compliance manager have been facing more and more challenges in the monitoring of three elements. We can actually, I'm going to mention a triple words a couple of times during today's interview. First of all, the dimensions of liquidity risk. Typically, the asset managers are asked to monitor time, cost, and volumes of the assets. But another triple is actually the width, the depth, and the resilience of the investment funds. So it's very important that we always look not only at the portfolio active, standalone, but we always rely also on the liabilities and redemptions. And we have seen, especially with ESMA, with the new guidelines issued by ESMA due in September 2020, literally this combination of asset and liabilities scenarios and monitoring. So this is very much the stress going forward. In fact, if you think, for example, individual investors who tried to sell shares of Apple or Microsoft, for example, are unlikely to impact the overall price of the stock itself. But the other way, if you have institutional investors trying to sell large blocks of these shares of a small company, will probably cause the price to fall. And as the price falls, also the smaller investors are actually affected and may be stress or maybe challenge in exiting the investment themselves. So the regulator is very much interested in looking at this aspect. So we talk about time, cost, and volume. So when it comes to the portfolio, the active side, these are the typical dimensions that the asset managers and the risk managers are actually required to ask. There's no real one unique standard approach in the market that aims to cover this. There are more or less complementary ways, from a liquidity scenario-based approach, from a volume approach, from a bid-ask approach. Of course, the challenge is to combine all these together in order to be as strong as possible. On the liability side, it's very important to monitor the investor's behavior. So try to anticipate as much as possible the investor expectation and possible shift in the expectations of the investors. So try to simulate, for example, the behavior of retail investors or institutional investors, how they, what is the resilience of the fund if the redemptions actually increase over time. So subject to a turbulent market like a COVID, what is the behavior? Is the redemption going to increase? Are the outflows going to increase, decrease? What is the pattern? What is the threshold that actually the fund can face and are able to face and to manage? So it's very important actually to combine both elements in order to be as strongest as possible facing liquidity risk, monitoring liquidity risk challenges, not only in the context of COVID, but more in general in order to respond also the internal and external requirements.
I find it fascinating that the industry in the buy side is also getting into liquidity risk with an ALM approach, almost like the banking industry. The banking industry has been approaching the problem of liquidity risk, which is clearly different in banking. But it seems now that assets and liability are coming together, and it's also the regulator that is sanctioning this. Am I right in saying that?
Absolutely, that's right. Considering also the different financial crises in different times, well, basically, it is pretty much clear, especially looking at the recent COVID, that under unpredictable circumstances, actually the liquidity or the volatility of the markets can suddenly change and the liquidity can suddenly vanish. So the lack of liquidity combined with also the nature of the modern derivatives has actually led to massive fund redemptions. So these clearly increase the pressure also to sell into the market the current market condition. So what is the result of all this? Is a rapid downward spiraling cycle, which may bring also to collapsing prices, and we have seen this over March. So what is actually the regulator starting requiring? We have seen this with ESMA guidelines issues last September, which just for a few months anticipated actually the COVID events. The resilience of the investment funds is of huge importance. What do they mean with the resilience of the fund? It means monitoring the capacity for the fund also to match potential redemption, to match the potential change in the expectations of the investors. And this is actually the key word, because of course, portfolio managers, asset managers, not only have to monitor, but have to react and as much as possible anticipate the changes in behavior. So there's a lot of stress, there's a lot of modeling around these, and it's important that all the focus of the, we can say solutions, risk solution and softwares are there, are very much a focus into this direction.
Very interesting, Chantal, thank you. How can technology help, right? Because market liquidity risk is a recent evolution of the financial risk technology. And where are the challenges? How technology can help, and where are the challenges? What are the operational challenges related to this about data analysis reports? Who of you wants to answer that?
I'll start. Technology can absolutely help with liquidity risk monitoring and reporting. There's a lot that goes into the calculations, the reporting. So from aggregating all the data to begin with from multiple systems, and then running the actual analytics, setting the parameters, monitoring, and then validating all the results, and then finally producing the, whether they be internal reports or external regulatory reports among the ones that I described, there's a lot of work involved. Beyond the individual calculations, you have to customize the outputs to your audiences. And those outputs either could be the regulatory templates or internal reports, or both. And some liquids, like NLiquid in the United States, require reports to be triggered based on any liquidity events. So it's the monitoring and the reporting and perhaps automation of those things. So you do need to monitor and report very quickly in some cases. And that reporting, in particular, NLiquid is actually going to be changing this year. So that's another aspect to all this, keeping up with all these regulatory changes. So they're not just events that come and have very clear, predictable responses. Sometimes you don't know what's going to happen. You have to keep up with the regulatory change quickly. So without dedicated technology solutions, you're asking a lot of your risk teams to be doing all those things, from the aggregation, the calculation, and the customized reporting and monitoring.
Indeed, if I just may add a very tiny sentence on top of Jesus' comments, the real challenge here is to have a solution which actually combines cross-functional aspects. So we talk about assets, we talk about liabilities. So the challenge is actually to find a solution which combines the quantitative, the qualitative modeling across all the asset classes, across all the aspects of the portfolio. So respond to the evolving liquidity regulatory frameworks globally, not only Europe, but we have mentioned also USCC. We can think also about Hong Kong or Australian regulation. All these together with a scalable technology, customized reporting, and of course find a solution that is parallel in today's market. So this is the real challenge.
Great, I understand, very interesting. And I mean, clearly with what is happening, what was already happening, clearly regulation was on liquidity risk has started after the big crisis of 2008, 2009. And it has been clearly evolving, I would say, in these years, even before COVID-19. But with what is happening with COVID-19, I mean, clearly liquidity risk is going to be one of those risks where it will require daily monitoring, right? It's pretty obvious. With all this data, with all this information, is this going to create a challenge also in terms of scale to handle?
Certainly. ESMA liquidity stress testing is absolutely a challenge in itself, from all the data monitoring and the reporting that needs to happen. But putting together a cohesive strategy for all of that liquidity risk monitoring and reporting will likely be beneficial beyond this single regulation. Like you said, it's daily monitoring, other reporting that we don't know, but will likely come. So we did see that broad-based regulatory response across all asset classes after the last crisis. So we should probably expect a similar response to this one. So getting your data and technology in order with organized and monitoring regimes in place now, if you don't already have them, will make it easier to modify and reconfigure them for any new regulations that come along or any tweaks to the calculations that need to happen. We know that the EU and the USA regulations are related but not identical. So you want to be able to have a system that allows you to perform both ideally and to respond to any future regulatory requirements.
That's right. We were mentioning earlier the challenge to have quantitative, qualitative modeling across active, passive, so portfolios and liabilities, and the different approaches we mentioned, bid-ask, volumes. These are not the only two. There are solutions involving also liquidity surfaces, for example. So it's important also to model not only the single snapshot, but also how the shape, the single securities, the portfolio change over time. So monitoring over time. So there are multiple dimensions here. It's not only a single day snapshot. It's not an exercise that you have to run on a quarterly basis and that's it. It's actually an ongoing demand, an ongoing monitoring that the regulator requires. So this implies also a large volumes, a large scale, large amount of data on a daily basis to be elaborated and monitored constantly.
Well, guys, thank you very much. This was very interesting. I mean, clearly liquidity risk is a topic that is gonna keep us busy for a while, for the good and bad of it. So thank you very much for your time today. It has been very informative, and thank you, everybody.
Thank you, Dario. Thank you.